So from March till now, what have you been doing?
So, thanks for having me on, Alex. So like you said, in March, on the 22nd of March, on that Sunday, there were a lot of REITs, non-agency REITs that couldn't meet margin calls, and things devolved pretty quickly into a cash grab. There was a lot of indiscriminate selling, but unlike 2008, mortgages were not the cause of the problem, nor would selling them be the solution. And this was a classic case of the baby being thrown out with the bathwater. So since then, we at Ellington have put about $3 billion to work in non-agency and other mortgage securities since that third week of March. There's a lot of dispersion of value in the market, and that's where you need a lot of expertise in some alternative data sources and things like that. But there's a tremendous amount of value, and the backdrop there is that the Fed has been aggressively buying. Mm-hmm. So if you look even previous to other quantitative easings, they've increased their mortgage holdings by over $500 billion net of paydowns since that time. The Fed now owns about 30% of the $6.7 trillion agency MBS market. So you see tremendous support to this market, and even compared to other times, you've seen this buying from zero on March 11th to now almost $2.5 trillion in assets in a relatively short amount of time, 3 or 4 months.
So I guess, Mike, the question is, what did you buy? And what did you sell? Like, what did you trade? Because March was a really scary time for most investors, and nobody knew the Fed was going to step in the way that they did. So, I mean, you took a cue and you took a big risk. So now what are you doing?
So basically, you have to have some dry powder for these sorts of events. I mean, this was the third or fourth one we've seen or I've seen, including my time on Wall Street. And I wouldn't say it was a yawner, but it wasn't as bad as other ones. And I mean, you just need to manage left tail risk. So if you've got some cash and you ask clients, come along with and raise some money, we put money to work as opposed to selling. And most of what we bought were non-agency mortgages. And we bought, as you said before, REITs. And I can talk a little bit about each of those types of investments. REITs in particular, as you mentioned, took a real beating in March. Since the beginning of 2019, if you look at the iShares Mortgage Real Estate ETF, which is called REM, that's dropped about 40% in price. This is a composite of agency, hybrid, and commercial REITs. And even probably as interesting as that is the price to book of the non-agency REITs that are the constituents that are in that index have dropped from over 20%, from about 90 to 70, meaning not only are the prices down, but the actual discount to the underlying value of the mortgage portfolios is also down. So we see tremendous value there. Ellington's REIT EFC itself has dropped about 20% price to book, for example.
So let's then talk about the non-agency part, because that's the real risky part. I mean, agency, you get the backing from Fannie and Freddie, so it's a little bit palatable to take that kind of risk. How did you find the value there? And if we don't get another round of real good stimulus, if we don't get a really solid extension of the unemployment benefits, does your view change on these guys?
It doesn't change a real lot, and that's a very good question. You're absolutely right. So there's no implicit or explicit backing to legacy non-agency mortgage securities. However, please keep in mind that these loans have been outstanding on average for about 15 years, and these homeowners have paid through 2008. They want to hold on to their homes. We feel there's very little downside in these securities because of the low loan-to-value in the loans that back these securities. Legacy residential mortgage-backed securities have housing price appreciation loan-to-values of about 50%. That means for a typical borrower, the loan outstanding is only half of the home's value. So investors are most likely going to get their money back at par if they buy securities backed by these loans. Like I said, it's been over a decade or more that they've been paying down these loans. I can give you some more data if you're interested. For example, pre-COVID, we were seeing 2 to 3% delinquency in this product, and now that's gone up to about 19% in June. Mm-hmm. However, like I said, you've got incredible protection to the downside if house prices drop. We don't see that happening. You just see 30 minutes ago, Case-Shiller came out, and there's a 4.5% increase in house prices year over year through May, and early indications suggest that that'll be true. That number, mid 4%, will hold from June to June 2019 to 2020.
So, Mike, do you have to look at it, though, more regionally? Because something that COVID did do, in theory, was move a lot of people out of cities into country homes or into Connecticut and out of New York City, for example. Do you need to look at stuff regionally on that basis when you're buying the non-agency guys right now?
That's true. I mean, there are the demographics of housing are very fragmented, and there's no doubt about that. But keep in mind, there's a lot of diversification that's built into the securities. You know, these securities are oftentimes backed by hundreds, if not thousands, of loans from various areas of the country. You know, and that said, there is, you know, anecdotally at least, you know, here in Connecticut, you see in southern Connecticut a lot of New York license plates, and you see, you know, housing, I think, we've been in Fairfield County up 12% year-to-date in housing. Nonetheless, though, I believe that there's plenty of cushion in any of these securities that we're buying. I just got some, you know, what happened, I believe, is we looked at one security we bought recently that was 350 basis points over the LIBOR curve at 20% delinquency. If you double the delinquency, you're still more than 200 basis points above the curve, and we don't see that happening because of house price growth.
And then last quick question here, Mike. Do you see us going back to where we were pre-COVID in terms of how these things are trading, whether it's REITs, whether it's non-agency mortgage backs, or is there always going to be some kind of discount now?
It depends. The marginal dollar has actually slipped away a bit. A number of hedge funds that were holding some of these securities have had to sell. That said, in general, I still believe most of these securities will be held by money managers, and with rates so low and the curve flat, they offer tremendous value. You know, compared to what else you're seeing, especially because it's hard to get direct housing exposure for money managers. And if money managers are getting a little sour on commercials or corporate debt, this is really the safest haven for them. So I do feel there's upside in a lot of these securities, and certainly in the REITs that hold them.